Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Joyce, managing director on Nasdaq's market intelligence desk, for an update to watch in technical levels with the Nasdaq 100. Brian, it's great to see you as always. And one thing you can say this week, we're certainly feeling the impact of the mega cap tech names in the index.
Yeah, we had some negative news out of China regarding Apple, so that's been weighing on the stock. Nvidia still hasn't been able to recoup those new highs it made on its earnings announcement. It's still holding up relatively well. Stocks had a phenomenal run year to date, so you could see a much bigger profit taking from here and still be in a well-established uptrend. But certainly those big mega cap names have a outsized impact on the index.
Yeah, I mean, it was interesting when we had Chris on the show yesterday. We took a look at the breadth within the Nasdaq 100. I believe it was 70 to 30 to the upside. In fact, 3 names hit 52-week highs, but you saw it, it was still in the red for the day, so it really does lend to the weighting that some of these names have.
Absolutely.
Let's take a look at some technical levels to watch in the Nasdaq 100.
Sure. So here we're going back to this trend line from the beginning of 2023. It's been a phenomenal year, record first half of the Nasdaq 100. And if we zoom in a little bit and we can see today's pullback, we're still holding within that rising trend line, which we've tested now 4 times this year. So the more times we test a trend line, particularly if it's rising, it's not horizontal, the more important that trend line is. So the market is telling us that this is an important level, and we're still holding up above it despite today's decline. So, and then if we want to look at the moving averages, we can see that we've rebounded off the opening of today's open, but we're now pushing up from the underbelly of the 50-day moving average right here. So that's something to keep aware of, to keep an eye on. And then if we want to put our Bollinger Bands on, we can see that today's low bounced off the 20-day moving average, which is the middle line between the upper and lower Bollinger Bands. So here, so a little bit, glass half full, glass half empty in the near term. When we're looking at the Nasdaq 100, I still think you want to focus on the longer term, the bigger picture. Obviously, depending on what your time horizon is as an investor. But if you're a bit of a longer term investor, this to me still looks constructive, which is simply pulling back above this level that we've really been talking about and highlighting since mid-June. So I think the onus is still on the bears to wrestle control away from the bulls during what's been an otherwise a phenomenal year for the index.
I think from a broader market perspective, though, what's happening in yields has given some pause to what we're seeing in the equities. Yeah,
absolutely. The yields and the dollar. If we want to look at the yields, the last 3 or 4 weeks, we've been, basically consolidating just below this, 435 level, 434 level in the 10-year Treasury yield. Short end of the curve is pretty much locked in. Maybe we get another 25 bip rate hike by the end of the year. Market right now is 50-50 on that. But even so, more importantly, I think it's the longer end of the curve that you really want to focus on. This to me, is arguably what looks to be setting up as a cup and handle kind of pattern. We had a phenomenal uptrend off those COVID lows where we're below 50 basis points. We're now at 4.35%, consolidating sideways just below that 3-4 weeks in a row right now. That's to me favors, I have an upside bias. If that were the case, you would, I think, start to see a further re-steepening of the 2-10 spread, 10-2 spread. And in that case, that I think would be concerning, because typically when that curve goes from deep inversion to positive territory, that's typically when you see the onset of recession. And then right now, as you mentioned, we were talking about the dollar. We're up 8 weeks in a row for the dollar. I thought maybe last week was going to be the top in the move, and we're beginning to break out from the prior highs from June. So we had the breakout from the declining trend line right here. We had the breakout above the 40-week or the 200-day moving average. Now we're getting back above the June highs. So the dollar keeps clearing expected levels of resistance.
Yeah, I mean, all the charts that we've looked at over the years, that does look like a pretty bullish chart. Firing on all cylinders, if you will. Let's go back to the yield curve for a moment here, though. I think we've been talking about this for quite some time, and it's yet to materialize into a recession.
Yeah, and it typically takes time. It's not when the curve goes into negative territory. It's either 15 or 18 months after that takes place, and really when then the curve starts to invert higher. Typically that's from a bull steepener, when the Fed is beginning to cut rates, which means higher prices. So far, what we've seen is the curve beginning to. We were at minus 108 basis points. We're now at minus 69 bips. We recently have been making this trend of higher lows, and we still haven't yet gotten back above the levels we saw during the bank turmoil back in March, April, which was about minus 40 bips, minus 39. I think until we start to make higher highs from there, you will be in this sideways range. And who knows, maybe that goes on for another 6 or 12 months. This has been a very unusual cycle since we've been coming out of the COVID lows. We've had tremendous hiking cycle and yet we're seeing new home sales going up. We've seen the home builders doing quite well this year, so not typically what we see. So, economists out there, strategists, traders, everyone's had to really adjust their thinking in this cycle.
I think they certainly do, because everyone has this expectation that rates are just going to start to be cut and come down. I mean, everything that the Fed is looking at, a lot of what the Fed is looking at are lagging indicators, right? It takes time for their policy to play out. It's a 12, 18, 2-year move that you can expect. I'd be really surprised if they were to do anything in the first quarter. And I think, perhaps the equity and bond markets are saying two different things for that reason.
Yeah, so the bond market has gotten it wrong, consistently, and it's been tough. And if we're talking about indicators, the jobs market, jobs are a lagging indicator. Inflation is, a lot of those metrics are lagging as well. I heard, one strategist yesterday making the case that maybe in this cycle that what used to be lagging maybe will now be leading. So industrial data, manufacturing data has been, surprisingly strong recently, but that typically is a leading indicator. But, in this cycle, will it be a lagging indicator? So, I think you just need to be nimble and open-minded, as to, any possibilities, particularly in such a strong inflationary environment, which I know is coming down, but what we came from.
But think about it when it comes to the housing market. It almost feels like it was a manufacturer, not crisis, but rates are just so much higher. Who's going to leave their home if they're sub 4%, which is why there's a stalemate in terms of supply. So, with interest rates moving as fast as they did in such a short amount of time, it's almost self-fulfilling prophecy that you're going to continue to have high prices because there's just nothing on the market.
Yeah, and it would have been nice if we had this conviction, 12, 18 months ago, and
right.
knowing when to buy the dip in 2022 or early 2023. And so, yeah, we can look back now and say, all right, there's not much supply of homes on the market. So what maybe if new homes used to be 15% of all home sales, now they're 30% of all home sales. And if you're buying an existing home right now, you're paying the market rate as far as your mortgage goes, which is around 7.5 percentage points. If you buy a new home, the home builders are subsidizing some of that cost, and now it's like 5 3/4. And so,
what if rates come down? I mean, do you even have any equity? You know what I mean? So it opens up a whole other can of worms, which sounds very similar to 08, 09 when people were underwater with their equity.
Yeah, and also you have a tailwind from the demographic side as well. The baby boomers, sorry, not the baby boomers, the millennials, excuse me. They're at that age where they're now buying homes as well, moving out of the parents' house, hopefully.
Hopefully.
So, there's a tailwind there. So obviously a lot of cross currents, and it's a global market. So when we're talking about rates, we're talking about the dollar. We also have to realize there's a lot of things that impact that. Not just what goes on here in the United States, but what's happening with Japan. They're coming off of their ultra loose monetary policy. They did in late July. That could be a significant pressure in global rates, not just in Japan, but here in the United States and possibly in Europe as well. So and then China as well. So China's dealing with a real estate quote unquote crisis, and they're trying to throw a lot of things at the wall and see what sticks. And they've announced a number of what seemingly are positive market supporting measures in the last few weeks. And so we'll have to wait and see how this plays out.
All right. Appreciate the insight as always, Brian. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.